Well, so yeah, my challenge is I'm in multiple corners due to the intersections that I operate in. If I look in the traditional macro area, most of them aren't really talking about crypto. A lot of them are kind of doing the thing where like, oh, it's dead, right? Kind of like how 2018, 2019, it just kind of not on their radar anymore. It's dead. Uh, same, including Bitcoin for that matter. Basically, they're just like, yep, the whole space bubble, it's gone. They view it kind of like ARC style stocks, basically unprofitable growth stocks. Um, Obviously, when I look at Bitcoin spaces or when I look at crypto spaces, which are increasingly kind of two separate spaces with some degree of overlap, um, basically the Bitcoin people are generally in pretty good spirits. I mean, I was at Pacific Bitcoin, for example, while FTX was happening, and so the Bitcoin price was nuking, the whole industry was nuking, and people were like celebrating and laughing about it, and just kind of just kind of rolling with it. Um, Obviously there's a lot of development happening in the space. People often talk about lack of Bitcoin development, but of course that's mostly base layer focus. There's actually quite a bit of ecosystem development, basically making Bitcoin easier, more accessible, faster, more expressive, things like that on various parts of the ecosystem. As for crypto, I mean, this week was big. I mean, the past couple weeks, there have been a number of people warning about increasing levels of banking system cutting off various crypto entities. And then we've kind of seen the hammer come down on custodial crypto staking from the SEC, basically kind of looking at that as like an investment contract that is subject to regulations. I think this has been rather telegraphed since the FTX debacle. That really kind of lit a fire under regulators, gave them a lot more, kind of just, coverage to go after certain things. We've also seen a shift in the head of the Commodities Futures Trading Commission. He used to kind of talk about Ethereum being a commodity like Bitcoin. He walked those back in November, those statements back, and kind of would say, okay, Bitcoin's a commodity. We'll see about everything else. We'll leave that to the SEC, which kind of, we kind of know Gary Gensler's view on that whole thing where, Bitcoin, maybe a couple other proof of work coins are kind of, commodities in his view, while everything else is at risk of being labeled a security. So I do think we're kind of seeing a shift away from some of these, kind of centralized custodians. And I think it's going to disperse globally. I think some of it's going to be muted for a while because it affects how much big capital can go into it. And so I think it's a troubled area, but I think there's going to be future bubbles, future growth cycles in this whole space again.
Bitcoin sought to end the week above $23,000 into the Feb. 26 close as concerns heightened over stubborn resistance. The latest move marked a modest comeback after a grim week for risk assets, with United States equities suffering thanks to above-expected inflation data. Despite that, Bitcoin still remained below levels flagged by analysts as important to reclaim before the end of the month. Hello and welcome to Money Talks. In today's video, Lyn Alden updates about her outlook for Bitcoin in 2023. She also breaks down the importance of regulatory clarity in the space and how it will drive the future of institutional adoption in crypto.
I think that's really important for quarter by quarter basis. Liquidity is not the only measure that affects asset prices, but certainly in the near term. Let's say a typical equity, right? How it performs over 5 years will largely depend on its fundamentals, but how it performs quarter by quarter will largely depend on liquidity and sentiment. And the same is true for macro assets, gold, Bitcoin, certainly other cryptos as well. And so these things are going to bounce around in large part based on liquidity. And that like a combined domestic liquidity indicator is a pretty good one. And there's three main components. And so we can kind of, outline what's going to happen with all three of them, right? So the Fed balance sheet is anticipated to keep going down for now. That's basically the Fed's intention to keep reducing their balance sheet, which is negative for liquidity, right? So that's kind of the background direction. Then you have the Treasury General Account. That's basically the Treasury's cash account with the Fed. And this one is inverse, where when it draws down, that's actually good for liquidity. That's pushing money out into the system. Whereas when it increases, it's bad for liquidity because basically it's sucking money out of the system and then just holding it there in this void that's not actually flowing into anything. And the Treasury targets to have around $500 billion just sitting in its cash account. But one of the things that happens during debt ceiling impasses, if it goes all the way to the end, is that one of the things they do when they can't issue more debt is they can draw down their cash account to keep paying their bills until they're able to issue more debt. And so, ironically, in the lead up to a debt ceiling, that could be positive for liquidity because that all that cash is kind of going out into the economy and it's not being refilled. And so actually since, basically quarter four, that has kind of been happening. It's been offsetting some of the Fed's quantitative tightening. So that's been pretty neutral. And then the third component is reverse repo activity, which is more esoteric, but essentially that's just another big liquidity void that's been built over the past couple of years. And that's been showing signs of flattening and rolling over. And if that does start going down, that's generally positive for liquidity as well. So the way I would describe it is that until assuming the debt ceiling goes down to the last hour, right? So assuming it goes into the summer, assuming that the Treasury's not able to issue net new debt, we're probably going to see a TGA draw down, and that's going to offset some of what we're seeing in the Fed's quantitative tightening. So we have kind of a neutral liquidity situation overall, most likely. I do have concerns around the second half of the year because at that point, if the TGA is drawn down, and the Fed's still doing quantitative tightening, if there is some sort of debt ceiling resolution, which you'd have to have at some point, and then the Treasury starts refilling its cash account, that's sucking liquidity out of the system while the Fed is also still doing quantitative tightening. That could be a double negative whammy for liquidity, and so I wouldn't be surprised to see pain ahead. But in order to get to that point, we first have to see how long this debt ceiling impasse goes and how far that TGA cash account does draw down. So that's kind of the flexible framework I'm working with this year, but it is subject to all sorts of change on a kind of a month by month basis. The Fed has been decelerating their rate hikes, but they're still doing quantitative tightening at their prior pace. And we have seen disinflation in a number of inflation measures. Some of them rolled over earlier than others, but now there's a broad enough rolling over that Powell has been basically a little bit more confident in his assertions around inflation heading down, while still reiterating that they want to remain tight for longer. This, I think, ties into some of the prior issues I said before, where they're kind of, he's actually cited the 1970s and Volcker a number of times, which is kind of concerning because it's more like 1940s inflation, and he's not really citing that period. It kind of, I think, shows, somewhat of a maybe a recency bias in that regard, basically around, kind of the sources of money creation. The Fed also, when they were talking about inflation being transitory or not being too concerned about inflation prior to this all happening, I also think they were showing a misunderstanding of money creation, which is kind of concerning from the biggest central bank in the world. It's not exactly what you want to see. So my overall view is that, he's getting a little bit less hawkish, but he's still reiterating that they're going to stay tighter for longer. And I think they're essentially going to try to stay somewhat tight until they break something, right? Until you have kind of like illiquidity in the treasury market or you have outright recession, I think they're probably going to stay somewhat tight. Now that is kind of complicated because if you look out long enough, that can actually be inflationary. If you have high interest rates on very high public debt levels and you keep running deficits anyway, that actually pours more and more money into the economy. Basically, the federal deficit is a surplus for the private sector, which sounds good unless it's money creation. It's inflationary over the long arc of time. But it does spell kind of risks, I think, for the rest of this year. I do think that the market is, I'm not betting on a soft landing. Let's put it like that. I think either you're going to get kind of an inflationary breakout or you're going to get a recession that temporarily quells inflation. And that seems to be the way that most economic indicators are pointing to by either the end of this year or early next year.
The week prior, hopes remained high that $25,000 would not pose a major hurdle, and that BTC USD would be able to dispatch it without too much effort. In the event, however, the magnitude of the task became apparent. In addition to asks on exchange order books, key moving averages, MAs, lay above, notably Bitcoin's 50-week and 200-week trend lines. The declining 50-week MA itself led McGlone to conclude that the trend remains downward.
I think for the vast majority of people, the best thing, if they want to have exposure, is just buy and cold storage some Bitcoin. That's I think, the cleanest way to do it. GBTC is really, and some of the others are kind of an option for people that want exposure within a brokerage account and don't really have another option. And that's kind of been the shame of the SEC is that, ironically, by not allowing a spot Bitcoin ETF, they've made it harder for just retail and institutional investors to access the space within certain of those pools of capital, right? Roth IRA, registered investment advisors, all these kind of pools of capital want some exposure, and they have to kind of go into worse products than they otherwise would if there was a spot ETF. We see that, for example, there's a successful spot ETF in Canada. There's also similar types of products in Europe, Latin America. It's kind of, United States has been a pretty slow jurisdiction in this regard. And so, overall, I don't think GBTC is very attractive, but it does have arbitrage opportunities if someone is willing to go deep in the weeds and kind of, watch that process unfold. And the good news is we are starting to see more brokerages offer direct exposure. So for example, like Interactive Brokers through Paxos will allow more direct exposure for Bitcoin and cryptos for people that want them, rather than people having to go through these, various vehicles that can fluctuate around, premium or discount to NAV, which I think cleans up the price exposure a little bit. So I do think it's going in the right direction, even though a lot of people are still kind of constrained about being able to buy the assets they want when they're stuck in a brokerage type of environment.
So, what are your thoughts about Lyn Alden's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.